That's it, RJ. We've crossed my imaginary made up threshold. How many people here is enough? And so welcome everyone to this Placer AI webinar, Retail at the Halfway Point. There are all other webinars, but then RJ, they're the ones that you and I get to do together. And those are my favorites. And so thanks everyone for joining. I'm Ethan. I lead marketing here at Placer, and I am joined by my wonderful colleague, RJ Hottovy, head of analytical research at Placer. RJ, thank you for being here.
Yeah, thanks, Ethan. It feels like we just did the 2023 preview, and here we are halfway.
I know, it's crazy. So what we're going to do today, we'll do, again, a super brief introduction to Placer for those of you who are new or unfamiliar. Then we're going to look a little bit looking back at what happened, and we're going to save a little bit of time to look forward and some quick expectations. We're not going to save time for QA. We're going to take your questions throughout the conversation. So if at any point there is something that strikes your fancy you want to ask, please hit that Q&A button at the top or bottom of your screen, depending on how you have Zoom configured, and we will get back to you either within the course of the conversation or towards the end. Introduction, again, super brief. Who is Placer? Placer is a location data company. What does that mean? People vote with their feet. We show you how they vote across the United States every single day. We do that by observing a panel of tens of millions of mobile devices. We then use aggregate data and we analyze it with machine learning and AI algorithms, and then present it in a wealth of different reports within our platform on everything from true trade areas, visit counts, the customer journey, cross-visitation, traffic routes, and a whole lot more. Please keep a lookout. If you are on this webinar, you will see it. We have some really exciting product features coming up in the next kind of couple of weeks, months. So make sure you're checking that out. There'll be things that will definitely be added to that slide I just showed you. But now it's time to dive into the content. And I think if we're talking 2023, RJ, you can't not start with the wider economic environment. So how big of an impact do you think these wider economic challenges have had on retail? And what do you think the key consequences are moving forward?
Yeah, I think that's absolutely the story of 2023 so far as, inflation has bled into just other, more macro headwinds. And it's had an impact across all of retail, and not just retail too. I think that's kind of the bigger story here, is that it's not just retail that it's impacting. It's restaurants, it's office buildings, it's migration. There's so many things that the economic environment is impacting. And, obviously, we can show a chart like this, which shows that, discount format grocery is outperforming the other channels, but we see it across so many different channels. We see it across channels. We see it in visitation trends to cities and things like that. So it really has become a pervasive story, and the one that I think rightfully deserves the most attention in the marketplace right now too. But I think the other takeaway too is that there are ways to navigate this too. So while it may be a difficult environment, most of the retail categories we look at are seeing visitation trends down on a year-over-year basis. There are some success stories, and that there are people that are doing some very interesting things to navigate this. So I guess that's the message here, is that while it's a difficult environment and that value concepts are generally winning out, it's not just low prices that are winning out. There's other things that retailers, that restaurants, that other companies are doing to drive visitations. It's an environment.
I mean, it's such a great point. I also think there's something really interesting about what are the long-term effects. So, you think about something like the trading down behavior that we saw. So how much of that continues afterwards? Like, it's not going to be, I shopped at this grocer and now I go to this grocer and I'm never going back to the other one. But does this kind of visit share grab? Does it continue? I think that's going to be one of the most fascinating storylines of like late 23 and into 24.
I think so too. I think that's going to be super interesting. And when you look in the past, it all kind of depends on the macro environment. If if wage growth increases, people start to trade up a bit. But I think it could be a little bit different this time too. I think what we're seeing at that value channel is particularly interesting. And what's interesting, it was something that I heard at a conference last week, something about kind of the split brain phenomenon, where for some categories people are fine going trading down, doing value, private label, all these different things. But on the other hand, on some more categories, more entertainment, things like that, they're willing to pay up for right now. And I think that's kind of where we're at too. So and I think in that same environment, there's ways, again, even at a value price point, that you can still drive or outperform your peers within that category.
That's a great point. So hybrid work to me is the single most significant direct output of the pandemic in terms of retail impact. Like, I think, most of the trends that we saw were, they're short term. I think hybrid work may be the only one that has a massive long-term impact. Do you think what we're seeing with hybrid work, do you think it's the new normal? And how much do you think it changes things for restaurants and retail brands if it is?
Yeah, I mean, the biggest takeaway when I saw the slide is look how consistent it is. Look at the growth. I mean, there's been some variation here and there, but if we look at kind of the overall percentage where we are return to work, we're still at about 60% of pre-pandemic levels. And this is visits, not visitors. If we take that visitor number, it's a little bit higher because we're seeing that middle of the week phenomenon where people are coming back Tuesday through Thursday. But it's been pretty stable, at least since the beginning of the year. And that to me kind of says, I mean, something major would have to change for us to see a major swing in this. And, we might start to see more corporations start to drive people back in the office, but, that's had a lot of employee pushback at this point too. So I think we're kind of settling into a new normal here. I mean, I think over time we will still see a bit of return, a bit higher than where we are, a bit more return to work, but I think we're kind of settling into a new normal here. And obviously that has massive implications for obviously commercial real estate, which to be honest, has been the number one question we've gotten from commercial real estate and financial services customers this year. But obviously the ripple effect that we see across retail, across restaurants, that's pretty significant. That has implications on not only where you put your locations, but also the size of the location, the format, how they're staffed, what kind of technology put in there. So I think that there's a lot of implications here too. And I think a lot of people are just starting to realize that this is a new normal. And frankly, a lot of the chains that we're seeing outperform are the ones that realize this pretty quickly. It's been in the news a lot, but a company like Cava, which just did an IPO last week, very successful IPO. But what was interesting about it is they've moved towards a suburban strategy a long time ago. This was always part of their plan, and 80% of the locations are now suburban based. And so they are seeing trends that are outperforming a lot of their peers that have been a little bit slower to rotate away from an urban strategy at this point too. I don't think retailers should forget about an urban strategy, but I think the way they approach kind of downtown areas and workplaces and office buildings really has to be thought about at this point too. I think there's still some opportunity, but the way you go about it is very different from where we were pre-pandemic.
Yeah, those standard assumptions have changed. And we got a question that came in. It said hybrid work and office utilization and impacts on retail, both in urban and suburban markets, identifiable trends, good or bad, who are the possible winners and losers for retail uses. I think it kind of starts with what you were talking about, RJ, of it depends what your strategy is. If you're kind of a suburban grocery chain, I feel like this is great for you. If you're a suburban oriented coffee chain, I think if you're retailers who's oriented towards a younger audience in an urban environment, especially if that urban environment has a big residential component, you might be seeing a better situation than you saw pre-pandemic. So the question is really, it's not a knee-jerk reaction of one size fits all. If you're in the urban scenario, react like this. If you're in suburbia, react like this. It's really asking, how has my audience changed? What does that mean for my day-to-day? And what strategies do I need to deploy to offset the challenges and maximize the opportunities?
I mean, at its core, return to office is a commercial real estate question. And, at its core, commercial real estate is a local business. So I think it's very case by case. It's very situational. What may work for, a strategy in New York is going to be very different from Tampa and Dallas and Phoenix at this point too, especially some of the migration trends we've seen there. So again, I don't think there's any blanket assumptions that you can make here. It really comes down to, a market by market, case by case situation.
Yeah, I totally agree with you. I think that there is so much room for creativity here too.
Yes.
How does this impact the restaurant that was oriented towards office business? How can that restaurant kind of turn itself around, identify new ways to kind of maximize that space? I think these are the big questions for the next, year, even beyond, because I do think this is a trend with real staying power.
Yeah.
Another thing that I think has been really interesting has been kind of the resilience and success of off-price retail. And as much as we almost take this as a given now, I do think we need to take one step back and think February, March 2020, the headlines were goodbye off-price retail, especially Burlington. They had just shut down their e-commerce site. There is, good there. No one's ever going to want to shop before. If you don't have an e-commerce site, you're done. These brands have largely said, we don't need to focus on digital in the way that others do, and yet have seen tremendous success. Do you think there are wider lessons for other retailers to learn from this?
I do. I think there's really two lessons that stand out to me more than anything else here. One is, again, you can't underestimate the power of a physical location. There's so many applications of that. And, we've talked about it in previous webinars too. I mean, I'm hopeful that, at some point in the near future, we can rest this idea that physical retail is dead, that is such a, faulty way of looking at things. There's so many reasons for a physical presence in retail. And obviously we've seen so many of the direct to consumer and, digital only platforms that have started to open up stores. They realize that it's a great customer acquisition tool. It's a great way to expose people to your brand. Sometimes it's, convenience factor. There's so many reasons for it. So again, the first lesson is that, physical retail isn't dead. And I think that off-price is kind of, example one, probably the best example that we've seen in that case. The other one too, is that we've spent a lot of time talking about value and being so important in this macro environment right now, but low prices aren't enough. I mean, it's one thing to have low prices, but it really has to be something else, another psychological trigger that brings people in. And, with what we saw, we're still seeing the after effect of some of the supply chain issues that we saw in 2022. And all of a sudden, the buying environment for a lot of the off-price retailers is really robust. And so they're getting access to a lot of great merchandise. And this whole idea of a treasure hunt atmosphere, that's driving people in just as much as the low prices. So low price is not enough, but it's got to be some innovation, some marketing spin on it. It's got to be something else that drives people in. We see examples across restaurants and other retail categories where it's kind of this innovative value or disruptive value, however you want to phrase it. That's really what's driving people in. It's, I'm getting something more than just low prices with this. And I know we'll talk about Target. There's another benchmark example of kind of innovative value, but that's kind of the two takeaways I see with off-price here.
Yeah, I mean, the thing that it bothers me a little bit when we talk about off-price success, especially with this kind of, it's the treasure hunt. It's like we could just as easily say, well, off-price is so inconvenient. It's so hard to find your product. I think there's something about, like, we talk about Omni all the time. I think we as a wider ecosystem have so little understanding of what Omni means, because I think in the end of the day, it's asking, what does your customer really want from you? How do you apply that with digital and physical? And sometimes that the physical or digital interaction is super counterintuitive. And I think off-price is one of these examples where, even though it doesn't, if again, I could frame this in a way that doesn't make sense, it makes perfect sense. And they understand what their customer expects from them and they deliver. It's so impressive.
Yeah.
Question came in. Did you see that AT&T is closing its corporate office in San Francisco? Why is this city seeing such a deteriorating office sector? RJ, I think it's a combo. I think it's one, the over-orientation towards the technology ecosystem, and then what happens when that ecosystem is so well oriented towards virtual work and the incredible expense that was associated with living in San Francisco. I think these are the types of factors that compound to create a really difficult situation for a city in a short-term period.
The third one I'd mentioned on that one too is migration trends. If you look at net migration away from major metro markets, San Francisco has had the most migration to other states out of any of the major metro markets, ahead of Chicago, New York, and a few others. So you combine all those factors, absolutely. The reliance on technology, which is still very much in a hybrid environment, inflation and other pressures, and just migration. When you add all this up, you can kind of see why San Francisco is being hit harder than a lot of other cities at this point.
Yeah, I just think it's a golden opportunity to return San Francisco to something more interesting than, it's just a tech hub. Like, I think this is again, there's opportunities in every challenge. All right, power categories. We think about, players like Ulta or Lululemon who have shown tremendous strength even in this environment. Are there secrets to the success? What are we to learn from these brands and the categories that they lead?
Yeah, I'll start with Ulta here because it's been a fascinating story to watch. And if we go back to kind of the overall retail categories that are, in terms of ranking performance, beauty and wellness was the top performing category in 2022, and it continues to be the top performing category in 2023. Some of this is, just a basic byproduct of, the great reopening, people wanting to be back out in society and wanting to look good while they're doing it. But there's a lot more going on. And, that's what I love about these charts here. There's usually about 2 or 3 other stories going on when we show these kind of charts. And what's interesting about the Ulta story more than anything else too is that, one, we just talked about innovative value. They've done a really good job kind of at the lower price point to, broaden their audience. And if we look at the trade area, the composition of their collective trade area for their stores, we are seeing that uptick in that lower income consumer. So they've done a good job on that front. They've also diversified in terms of the ethnicity. They've done a really good job cultivating some more emergent brands that, have a much more diverse, customer audience than some of their traditional brands. And so I think that's kind of the story here is it's not just the idea that, a rising tide lifts all boats for the beauty category. If you look at their performance compared to the beauty category right now, they're doing a really good job. And some of it comes down to the merchandising initiatives and, giving people some innovative value and, broadening the assortment there too. So I think that's, very interesting to me too. Lululemon and apparel overall and some of the other categories, Lululemon's done an excellent job just kind of cultivating the brand and, fended off a lot of their peers. Obviously, that's not a value play, but for the high end consumer right now, generally they've shrugged off a lot of kind of the macro pressures, if you will, but they're being more selective in what they're buying too. And it really comes down to the merchandising. And I think Lululemon's done a great job on that front.
I think, there is something about why do you go to a store? And
Yep.
this is a big question. We talked about this a lot, but if you're buying makeup, I'm sure there are great technology solutions that will come. The ones that exist today are not fantastic for understanding how something works with your skin tone and type. And there's something about the experience of the store, the experts that you have there. I think there's such a lesson to learn just about service and why
Yeah.
do people come to a store and how do you give them the shopping experience that is better than what they can do online.
Yeah, that's a great point because if you look across the board, those retailers that are generally more associated with experiential retail are definitely the ones that are winning right now. And I think that's absolutely a key point and, certainly a point of why Ultra, not just the only point, but it's certainly one of the many reasons why Ultra's outperforming right now.
Yeah, I very much agree. All right. The flexible consumer. This is one of my favorite topics. I think it's super fascinating. When we think about, for context, when we looked at early stages of the pandemic, shoppers were going out less, even to essential retail, but they were spending more time when they would go out. And this was maybe called mission-driven shopping, fewer visits, more purposeful, longer visits to each location. That went away when the pandemic impact started to die down. But as each next wave of the pandemic happened, we saw the behavior return. And then it went away as we were in the kind of fuller recovery. But as gas prices rose in 2022, we saw the behavior return. And then inflation started to have its impact. And we see this behavior kind of continue. I think it's really interesting because it shows us that consumers are willing to be flexible in order to make brick and mortar retail a part of their experience. From your perspective, how can retailers leverage this flexibility? And what are the risks to trying to leverage this flexibility?
Yeah, this is another one of those slides that, there's 3 or 4 stories behind each one of these, charts here. And it's fascinating because I've been watching it on the grocery category for some time, this, the dwell time being up in a lot of cases here as well. And, there's so much behind it. I mean, I think to your point, it does show that consumers are a bit more patient and that they're willing to come a further distance in a lot of cases to a retail location, particularly if they think they're getting a deal. I think that also shows that there's a lot of price shopping happening at the store. The fact that it takes more time to compare things on the shelf and people are going to compare, what the price of a store's private label product is versus a national brand. There's probably also a labor component here too. The fact that you do have a lot of turnover in the retail category as well. And it may not, be smooth at the checkout line as in some other cases as well. But most of these retailers here are pretty well operated. I don't think that's the issue on this case. But getting back to the question, I mean, I think what it shows here is that, again, having the right merchandise in place will drive people there. And this idea of innovative value is going to drive a longer dwell time, which we've shown time and time again, that can drive an average ticket higher, which is what you need to make, your retail location work in this environment. So that's, really the key message, I think, underlying everything this year is that with inflation, everything's gotten more expensive and you need to find ways to draw visits to make the return on your store asset that much more, work in your favor. And I think that these retailers that have started to figure out and seen that dwell time that, bleeds in everything else they do, higher ticket, which leads to higher operating margins. And that's how you do it here.
That's a really great point. All right, it is time to talk about the pull forward of demand. We talk about inflation, we talk about the economic headwinds, but I think the pull forward effect is really significant. think we've seen segments like home improvement start to recover, consumer electronics start to recover from this, say, massive peak, and kind of the inability to then still also have demand from other
Yeah.
peaks after you've seen such a height. But I think there's an interesting element of, okay, what does it mean for other thriving segments? So, you and I have had a shared passion for how impressive fitness has been, but it is possible that those unique heights hit that kind of running counter to all standards of seasonality in the sector pre-2022. Does it set up some of these other segments for a pull forward of demand effect? And how do you think we should contextualize performance for segments like fitness in the months and even years to come, considering the comparison to that height hit last year?
Yeah, it's a good question, and I think this is another one that you almost have to compartmentalize each one of these categories, because there's a lot of different things going on. Again, a lot of stories going behind the graphs here. Home improvement is very interesting because obviously we have seen the declines, big declines year over year through much of this year, and initially it was kind of the do-it-yourself consumer that had done those house projects. All the Home Depot, Lowe's have talked about price sensitivity of consumers, and that's certainly something we're seeing there too. Now it's starting to bleed into the pro sector, particularly those home projects that require any kind of financing that obviously be subject to higher interest rates at this point too. But what's interesting is now for kind of the smaller pro projects, where Lowe's is kind of especially specialist on, we're starting to see them kind of narrow the gap. If you look at even the May and June numbers, they started to narrow the gap there. So it's kind of interesting. We're starting to see that improvement, that come back for smaller projects. There still is demand there, and even though we saw this pull forward demand, it's leading to tough year-over-year declines, there's still some momentum in that category. Fitness has been an interesting one because we've got a lot of questions from people. How is the fitness category up so big when we saw, according to the IHRSA, which is one of the trade groups for the fitness category, there was 22% of locations that permanently closed during the pandemic. How is we seeing this incredible visits? And so one thing it's important to note on our slides is this is chains. These are chains that we're measuring here, and chains were the ones that absorbed all the lost visits to small independent locations that closed. A lot of times these were small box type fitness studios. A lot of those closed during the pandemic, and that's been absorbed by the overall fitness category. So that's why we're seeing these big numbers compared to the previous year. Now, obviously those numbers are slowing, but I think what's interesting is that when you look at categories, we have to look at what is just a pull forward demand and what's actually seen structural changes. And I think fitness is one of those categories. We've seen some structural changes too. I'm not going to say we're not going to see year-over-year declines. I think we are probably headed that way with where we are. But I think it's going to be very different. I mean, you used to be one of when you saw a recession coming, you could almost count like clockwork that you were going to see fitness category was going to be one of the first discretionary purchases that consumers did away with. But I think it's very different. I think the paradigm has shifted, and a lot of it, goes to groups like Planet Fitness or Choose or Blink Fitness, these kind of lower entry price point, $10 a month, you can get in for $10 a month. They obviously have their other pricing tiers as well. But I think that's what's really interesting about this is that that's changed, at least that seasonality effect, where we used to see this big jump in the first quarter, which we still do, and then a big decline throughout the year. That stabilized a lot of the seasonality in this. The other thing we've seen, one of the other big drivers of growth for the fitness industry is we've seen a lot of younger consumers that are more frequent visitors to the gyms and fitness centers. That's had a major impact on overall trends as well. So, I do think we're going to see kind of that pull forward effect. I do think we're going to probably see fitness visits go down year over year just because of macro headwinds. But I don't think it's going to be as extreme as we've seen in past recessions here too. I think that there's been some structural change in this category.
Question came in. I want to hitting on Home Depot, the home improvement sector specifically. It says that it was the worst quarter for the company in 20 years as consumers did away with large home improvement projects. CFO Richard McPhail told CNBC that this year's pullback was expected, especially because of high mortgage rates and shifts in consumer priorities. I think this is exactly it. I think the interesting thing about home improvement, though, is the comparison to a really strong period in the last few years. The unique challenges of the economic environment are creating a short-term challenge, but I don't think the long-term opportunity goes away. So we think about things like migration trends. One of the biggest things we saw was that move away from cities to the immediate suburbs, that moved a degree or two of separation away from the city. That means someone going from an apartment to a house, having more things to fill, and maybe they're delaying some of those projects, but I think those are still going to come. I think the long-term prognosis for home improvement is not any worse than it was 2 years ago. It's just a short-term stumble in the path of something much more exciting?
Yeah, 3 points. One, there's continued wear and tear on the house. We talked about return to work trends. More people, that means more people in their houses. That means more wear and tear. There's going to be demand for it even after this pull forward. Two, millennial household formation. That's a factor too. First time homeowners. There's not enough supply of homes right now, but there are first time homeowners that will drive demand. And then third, you nailed it with the move to suburban and even rural areas. And we measured Lowe's visits at their suburban and rural locations, smaller markets, and they're like 20% ahead of what they are in large markets right now. And as that continues to play out, I think there's a tremendous amount of demand that we'll see going forward.
Great point. A question came in, and I want to address it because I don't have an answer for it. RJ, I don't know if you do. For me, it's not something we really see in our data. But someone asked, how will the impending retail theft affect the retail sector? We've gotten this question a bunch from a variety of different sources. It's just not something that our data really contributes to, but I don't know if you have, from kind of your experience, a perspective on this.
Yeah, I mean, it's certainly an issue. And I mean, the amount of discussions about theft and churn or it's really, I mean, it's been a very, right at the front of company conference calls right now. I mean, I'd say the only place we've seen it, and it's hard to break out, specific factors on this, but we have seen, again, the suburban locations for a lot of chains outperform the urban chains where typically a lot of that theft has been taking place. But again, there's other factors too. We've talked about migration, return to work. There's other factors at play. So it's hard to isolate exactly the impact. It is a major trend going on. It is a major disruption within the industry. I think if anything, I mean, we're going to continue to see store closures because of it in urban markets and rotation to suburban locations. But again, it's hard to get any direct reads on the theft at the locations other than the variance between urban and suburban locations right now.
Yeah, it's an important point. Okay. One of our big things that we talked about at the end of 2022, look out for this, the end of this year, RJ and I do our annual kind of looking ahead webinar that we love, that we kind of get really excited about. One of our expectations was some real strength in the potential of the mall recovery. Has your position on this issue changed? Are you still bullish on malls, and specifically top tier malls, what they will accomplish in the coming years?
Yeah, I'm definitely still bullish on malls. And, again, there's really two things here, two stories, two factors that I look at. One is that, if we look at the malls that have done a really good job kind of promoting their own brand, the brand of the mall itself, or, engaging in community engagement type efforts, getting people out there to concerts and other things, doing loyalty programs, the ones that are innovating around the brand of the mall itself are seeing success. So that is working. It's not something that, we're seeing across all channels. We are seeing success stories for those brands that are innovating around the brand, the mall itself. The other one too, is if we look at kind of, overall mall traffic versus e-commerce, because everybody, assumed that mall was going to die because of e-commerce, but, e-commerce right now has settled into kind of, let's call it a mid-single digit growth rate. But if we factor out even inflation from that, we're probably talking about low single digits, probably even, slight declines in year-over-year traffic too. So it's not just mall traffic that's being hit. This is a broader macro issue in that we're seeing impact across e-commerce as well. So when we factor those two things in, that there are, success stories where, malls are still driving positive year-over-year traffic for those groups that have done a good job, either, in terms of tenant mix or, engagement, other things, that's hope for the mall sector. And then two, again, comparison to e-commerce. I mean, it's, a sector that, we're also seeing pressure. So it's not like we're seeing a massive channel shift in from physical retail to online retail right now.
It's such an important point. I just think it's kind of the same thing with home improvement. Did any of the foundations change that made you bullish before? And for me, the answer is no. It's the diversity of tenants and the ongoing push there, the focus on audiences coming closer, the move to the suburbs, the lack of retail space, the widening long tail of retail, push for pop-ups and urgency. I just feel like when we talk to top tier mall owners, they are incredibly confident about what the coming years hold. And a lot of it's because of some really smart decisions that they made years ago. So, I mean, for me too, I'm ready to kind of die on that hill. We had a question come in. Any thoughts on the impact of third-party delivery in the food category, specifically the habit change of consumers and the specific broadening of the user base, older, lower income, etc.? Will it remain a dynamic influencer? RJ, your thoughts?
It's an influence, and obviously we saw the shift towards delivery, and a lot of times that was being facilitated by third-party delivery. But what's been interesting as we've kind of moved on, that was certainly a 2020, 21, and even 2022 trend. But I'd say the interesting thing, if we look at kind of the 2022 and 2023 in the restaurant category, is that if you look on a year-over-year basis, actually in a lot of cases, digital and delivery orders are actually down compared to previous periods as well. There's any number of factors to that. I think that certainly the fees that go along all the time with the third-party delivery has been an impact on that as well. A lot of times people just realize, hey, I can save myself that $6-7 by just driving that 2 miles to that QSR, that fast casual location. I think a lot of the restaurant companies have gotten smarter about that themselves too, sometimes employing their own in-house delivery, and a lot of times new formats. We've talked about changing urban environment, changing the way you do things, and we've seen a lot of ghost kitchens pop up, or prep kitchens, whatever you want to call them. Obviously, there's a lot of different formats you can employ in that, and so being better about that, and reducing your dependence on kind of the third-party delivery aggregators. So I guess long way of saying that I think delivery is here to stay, but it's also going to see people takeout orders, or I think are also equally important. And I think that's an area we haven't seen as much attention on, is the idea that drive-through innovation. When you start to add that second and third drive-through lane, we've seen some really promising results from companies like Taco Bell and Shake Shack on that front, that have added those multiple drive-through lanes that accommodate that increased takeout order. So delivery, we're certainly continue to see higher incidence of delivery orders post-pandemic, but there's other ways that restaurants are getting food to consumers at this point.
It's a great point. You know what I want to, it's so funny. So we got a question that came in. It's just more like kind of a comment, but I do think it's something I want to touch on. It's important to remember that what gets measured as e-commerce is where the product is ordered, not where it's filled with buy online, pick up in store. You can have e-com without a hit to store traffic. I think it's a really important point. And I will, very cheekily just steal the terminology from our good friend Steve Dennis of kind of harmonized retail. It's about looking at these channels as feeding one into the other. I think that's still the best way of defining this. I wish I had thought of it, but unfortunately, he's smarter than I am. All right, here, let's stay with the restaurant question for a moment more, because we got a question that came in. Is there any longevity to ghost kitchens?
I think you've done right. I mean, and that's obviously a broad statement. I think there's some longevity to it, but it's got to be smart about the way these things are built. I mean, sometimes I think the way a lot of times I've seen it work is where you repurpose part of your kitchen, particularly in an urban environment. Maybe carve out that 100, 200 square feet that dedicated solely to delivery or takeout orders. What I like about that is it doesn't require a ton of upfront capital to do. It separates the experience of the store, because a lot of times what ends up happening when you try to run a digital delivery business out of a traditional restaurant, you end up killing the experience for kind of that walk-in customer. And so I think that those cases where, again, you're tacking on additional square footage to the existing location, or really small locations that don't require cheap rents, things like that. So if you're done kind of in a smart way, capital efficient way, I think that there's some longevity to it. But again, it kind of one of those things where it's a case by case, situation by situation type discussion.
And one more before we kind of go into the next slide. A question came in: are malls more viable in any particular geographies? It's interesting, because we have seen some interesting data on this, that the distance necessary to drive to reach the mall is highly correlated with mall success. Also, visit duration. So the amount of time you can spend. Is the mall where you can spend the whole day out, they're more likely to be doing well on the visit front than those where it's part of kind of the journey, it's just a piece. I'm not going to spend the whole day there. So I think there are a lot of factors. I think it's less geography and a little bit more kind of those other factors like distance, what's on offer at the mall. RJ, I don't know if you have any thoughts on that.
Yeah, the only thought here is too that there's two metrics at play that I think you have to kind of balance when looking at the mall performance: visit frequency, per customer, and distance driven. Because a lot of times we see that maybe the frequency is really improved, but the distance driven is shrunk. That's because people are coming more often they're nearby. In cases where visit frequency may be down, but they're driving for a longer distance. It's kind of, you have to look at both variables to kind kind of get the whole story of what's going on there. So again, kind of case by case situation, but and geography based here too. There's a lot of situations where you maybe just there's less malls in that area and it requires a longer drive. But it's been fascinating to look at because there is an interplay between those two variables.
Yeah, it's a great point. A point came in, and I do want to say it says, month over month improvements are due to seasonality. Traffic builds as the spring and summer arrive. The year over year decrease is kind of the headline. We completely agree. I just think there is something to be said for what is especially in a period of volatility where things aren't as quote unquote normal as they were in the past. It is still noteworthy that things are moving in the direction that they did. So yes, that's why we're showing both. I think it is a more complex story than just year over year or clearly just month over month. Now it is time, RJ. This has been my big mea culpa. It has made me very, very sad. I thought Bed Bath & Beyond had recovery potential. I really felt like it could turn around. There was that one earnings report where it felt like it was, and then they let go of the CEO and it was kind of all downhill from there. From your perspective, what do we learn from kind of the demise of Bed Bath & Beyond?
Yeah, there's a few things. There's certainly some lessons learned, and kind of in post-mortem and retrospect, looking at things here. And again, looking at our data, there were some signs that you could see. One of the things I like to look at is kind of do a histogram or kind of distribution of stores by visits per square foot, and typically we see a pretty normal distribution, kind of the bell curve that you typically see. But Bed Bath & Beyond was a little bit different, where it was all concentrated to the unfortunately the left-hand side of that graph, which tends to mean that all the stores were kind of performing the same. There weren't kind of the typical outliers, on one side or the other. And typically when that happens, that usually is a broader merchandising strategy. And I think even the management admitted that they went too far with some of the private label strategies that they had, and lost some of the national brands that were a draw within the stores. So I think that certainly is at play too. But again, the underlying data, there's some really interesting takeaways here too. The other one that really caught my eye when I was looking at this story here was that they over-indexed to renters as opposed to homeowners. And that's something that we have with some of our other third-party data sets. That group was hit harder, either because they were kind of more urban settings or saw a ton of rent inflation. So that was a group that that was another issue that we saw there too. The other lesson too is that store size. It was interesting when they first announced their store closures, and I think I may have brought this up on a past webinar, but it's worth repeating here. When we looked at the stores that were closing, a lot of them were in the 95th percentile in terms of visits per location. And why would they be closing a location that you think would be successful? Well, when we converted that to visits per square foot, it went from the 90th percentile to like the 30 or 35th percentile. And so that just showed that maybe the stores were too big, maybe not getting the return that they were seeing. They should have been getting on those type of stores. So I think that there's some lessons here too. Like, you can see some of these merchandising issues. When that happens, it's better to make a course correction quickly. Maybe in terms of site selection, look at some of the underlying macro trends are there, and the store size. It's a big issue right now. A lot of stores were built for a different time in retail, and so we have to be mindful that maybe you can get more bang for your buck with a smaller store size, and still while providing a nice experience at the same time.
Yeah, all very good points. I'm still sad about it.
Yeah.
Retail media, one of the interesting things is we talk about this, and we talk about it very much from the perspective of physical in stores. We're not talking about kind of search oriented on like Amazon.com. We're really talking about kind of things like cooler screens, digital screens within stores, sponsorships, promotions. One of the things that so I think because of that reason, so this kind of, is it, digital is versus physical, the how new it is question, I think there's been some pushback on the potential of retail media, especially within the physical environment. Do you think it's deserved? How big do you think retail media can be in physical stores?
Yeah, I still think it's a big opportunity. In fact, if we look at kind of the technologies that I think are most impactful, most influential within the retail category, we're probably, retail media is probably second only to generative AI at this point in terms of things that could potentially move the needle. Again, we talked about the idea that, this year being so critical as we're seeing rising interest rates, things are getting more expensive to get a good return on your assets. And so I think that still retail media is an important factor that can kind of help you do that, particularly for the lower margin, higher frequency retail categories. So I think there's still a huge opportunity. I agree that it's not going to be game changing for everybody, and that there's certain retailers that probably should not get into it, particularly the more experiential ones. Although there are some subtle ways that you can do it as well. But for kind of, the high frequency kind of, lower margin, there's certainly still opportunity. And, I look at it less so from, kind of the brands themselves, kind of the vendors to those particular retailers. I still think the bigger opportunity is kind of other local retailers being able to advertise in that, whether it be, a fitness club next to an HEB or something like that, or another retailer, non-competing retailer. Those are the big opportunities to kind of leverage that. I think, and certainly it's interesting when we look at cross-visitation data, for those groups that have really, employed a retail media strategy, you do see a lot of opportunities in that too. So, yes, there's been some pushback on this front. I think that's still a lot of, again, you ask 100 different people what retail media means, you probably get 100 different answers. And so I think there's still a lot of confusion out there what it specifically means. But I think at the end of the day, the opportunity to leverage your store asset in a way that you hadn't before, provides an opportunity. Now, again, it has to be done smartly, but I think there's still an opportunity with it.
I think it's enormous. I can't, every time I try to like convince myself, try to like understand the environment, the argument, excuse me, of like why it's limited. I just don't think it is. Like, I mean, obviously there's a cap on it, but in terms of where its starting point is so low right now, of what it can, where it can be brought is such an enormous opportunity. It brings so much value, and it's a fundamental rethinking of the store. I mean, we've talked about this so often, but we had a colleague, Andy Murray, was on this a webinar with us, and he said, like, we need to stop thinking about retail media just within a digital lens. You're part of the discovery experience within a store. How do I get you more engaged and more excited? Keeping you in the physical environment, not taking you to your phone. I think there's some really exciting elements here, and I still remain super.
It's one of those ones it's going to take time. It's something that it's going to take time to change consumer behavior. That always takes time, and so the return may not be immediate. You may not see that measurable right away. But I think you're right. I think there is a longer term opportunity, and as we start to see some of this creativity and this innovation on this front, that's when we'll start to see the return there too. So I think it's very early stage. I don't think we should benchmark the performance of the first half of 23 for retail media as the end all be all for this particular category.
Yeah, great point. All right, let's quickly touch on two more, and then we'll have to kind of close up. What are your expectations for back to school?
Yeah, I think it's going to be a continuation of what we saw in the first half of the year. I mean, I think the focus on value is going to be very much front and center. I think we're going to see, big growth for those kind of mass merchants that have done a good job in terms of innovation. Target and Walmart should do a very good job. Off-price retail, another one that should have a big, second half. I love this movie theaters graphic here too as well, because this is one that, has been a down and out category. If you look at kind of year over 4 year trends, movie theaters are still one of the weaker performing, but year over year, one of the top performing categories at this point. And this is one that's strictly a play on kind of the overall release schedule. Now we're starting to see more tentpole releases and things like that. My colleague Thomas Paulson's done a lot of work on this and said, hey, the number of releases coming out in 24 and 25, a lot of reasons to be excited about this category. It's not, not Left 4 Dead. There's a lot of things. They still have to innovate. There's still a lot of improvement within the experience that they need to do, but it's a much healthier release. So if I had to frame kind of back to school, it's still very much focused on value, but kind of the idea that, the experiential component too. We've done some work on things like entertainment and movie theaters and things like that. Still people want to be out there and about after the pandemic. And so I think that there's still some opportunities on that front, even with a more, frugal mindset.
So let's end on this innovation. Right. I think there's a lot of topics that have been discussed at certain points over the course of this year. What's the big innovations? What do you think the most important innovation that we should be looking at in the second half of 2023? And it doesn't necessarily mean it's going to have an impact immediately, but what's the most important innovation that we're discussing now from your perspective?
Yeah, I mean, I think it's a disruptive value. Not enough to just have low prices. I know I mentioned this before. I mean, low prices are great. That's table stakes. That gets people in the door. But that doesn't differentiate yourself because some of the large players can match that in pricing. It's got to come down to innovation, just doing something that people haven't seen. And so Target's done a good job. They always have innovative brands at the lower price points too. So I think they do a phenomenal job. And I know, yes, things are down year over year. There's other factors at play. But I think they've done a really good job on the brand assortment, giving people more bang for the buck, just kind of the idea that I want to go and see the brands that are there and you experience that. Groups like Aldi, I mean, which is still largely private label, they've done a good job innovating around different flavor profiles and new things. There's always this element of surprise and newness when you go in there. I think that's also kind of an area we're seeing it. I mean, we see it in the QSR sector too, the idea that, celebrity meals or adult Happy Meals, things like that. I mean, we just, talked about it recently with some colleagues, just, all the new things that are coming through, new celebrity meals or, new promotions within the QSR space. That's, and typically at the lower price point, not always, but sometimes typically at the lower price point, those are the things driving it. So I think the idea of disruptive value is really, if I had to kind of hone in on a theme of 2023 and what to look for in the back half of the year, continuation of that.
That's a great point. I want to thank everyone for joining us today. We're at time. This is great. We literally had dozens of questions and comments come in, so we really appreciate not just you joining, but you actively participating.
Yeah.
It makes this so much more enjoyable for both of us. So again, thank you for being here. We've got a bunch of great webinars coming in the next few months throughout the summer. So please look out for those. RJ, thank you again, my friend. It's always a pleasure.
Always a pleasure. Always looking forward to these.
Yeah, and now we just have to mark down December. That's the next one.
Exactly.